I'm going to keep an eye on Asian markets. It may tell us what's going to happen tomorrow in the US markets. It doesn't change what I'm going to do tomorrow, but it maybe just gives me a preview. In the US, right, we had a positive week. And, the S&P over the last 5 days had positive 1.3%. That's fine. If we look at the S&P, it's been going up really nicely. And, I am not going to complain about seeing my stocks go up in value. I'm not going to complain about my portfolio going up in value. Not here to complain about that. But what I am here to share with you is that these graphs are beautiful. They're great, but they don't go up forever. At certain points, we have corrections. And that's what I begin to worry about again. I'm like, not intrinsically a big worrying kind of person. I try to manage risk and put it away. So my comments around, I begin to think at some point we're going to have a pullback. Did somebody have a question? No question? Okay. And it's just a way of, investing from my point of view is I want to have awareness. I want to have awareness of the market, the economy, the overall situation, and really theorize, what do I expect in 2025? Is the market going to go up 25% like it's been going up this year, 2024, and it went up in 2023? Now, if that happened, I would be surprised, but I would take it. Thank you very much, stock market. I'll see my stocks go up in value again. But investing, successful investing is not about, looking at the rearview mirror and saying, oh, that's great that happened, and that's great that happened, or, oh, that's too bad that happened. It's really trying to understand, what's going on today and seeing where the investments are going to be good. And again, my conclusion is that healthcare stocks, I think, are set to do well, because if we have a recession, which I expect we're going to have some form of a recession coming up, healthcare stocks do well. They didn't do well for the last 2 years, not like technology. I think technology stocks really took a lot of the capital, especially capital from investors that like high growth. But if you look at companies that are in healthcare, like especially these small pharmaceutical, small life sciences companies, man, they grow really well. So that's attracting my investing, or my capital is putting money into healthcare and small stocks. I talked about BT. I mean, that's as small as you can get, right? That's super small. But you could even put Zoom in there, which is only a $20 billion market cap company compared to the behemoths of Apple, Microsoft. It's tiny. Those are like over 3 trillion. So, all right. So a couple of stocks have come up. It looks like Ford, and I think Kidder, you had a comment. Let's see here. So Kidder, I heard that we are halfway through a recession in the market forward, pulling this retailer's example bottom. Yeah, it might be, because a lot of the economic data is really behind. It's almost like they tell you, oh yeah, by the way, we had a recession. So you may be right. In a way, I could see that. We're going to have next week, we're actually going to have a report on GDP. So this is the report that I was going to kind of highlight. On Thursday, we're going to see a GDP report, gross domestic product. And now recessions, and I've heard this kind of be debated a bit, but classically, my understanding is recessions are when you have 2 consecutive quarters of negative GDP, negative growth domestic product, or gross domestic product, growth in that figure, as well as increasing unemployment. So that combo is what is a recession. And in general, I think we know the negative, undesirable aspects of a recession. More people are unemployed. They spend less money. Companies find it harder to sell their products and services. Their profitability goes down. Cash goes down. So I do believe we're going to experience a recession if we're not in one already. And I do expect that that's going to have to process it through our markets. The story that the Fed is going to reduce interest rates, and frankly, I think that and I don't think they have anything else to talk about, which is why they talk about it. But I think the news outlets like CNBC and Bloomberg, they just talk about these rate cuts endlessly. It's like, I get it. They're going to reduce interest rates. Got it. I got it, 2 weeks ago when you said it. Since then, you've said it 100 times, if not 1,000 times. I get it. It's not that big of a deal. They're reducing interest rates. All it changes the discount rates on stocks. It's going to change the borrowing rates. I get it. But to expect that it's going to really move markets, not sure that's going to happen. Now, the story that isn't told enough is it's almost treated like, okay, the Fed's going to reduce interest rates. And that's going to be favorable, especially to growth stocks. I get that rationale. But the piece that's missing is the Fed is going to reduce interest rates to telegraph that a recession is here or coming. Now, that news is bad news because certain industries are going to get hit hard. In recessions, travel stocks are going to get hit hard. Consumer discretionary products are going to get hit hard. Certain things are going to get hit hard. Maybe we see more bankruptcies and that kind of thing. So I don't know that enough of that is being talked about. Is hey, at what point is the recession going to hurt certain sectors? So that's just some food for thought. So next week, this is the report that I'm keeping an eye on, the GDP reports. I think that's going to tell us a lot. These could move the market. If it comes out that, oh, wow, you know what? We're at negative GDP, I'm willing to bet that the markets are going to go down. The other thing that's going to happen that's huge news next week is earnings on the 28th. NVIDIA announces their earnings on the 28th. And I'm really going to watch that because obviously NVIDIA is the stock of the year, the stock of the last 2 years. So we'll see what happens there. All right, so we wanted to look at Ford, and let me make sure that I didn't miss any comments. So we're talking about Ford and then VLO. So VLO, Valero. Yeah, I think we've looked at Valero previously. And Valero, in the oil business, you have upstream. They find oil, they drill for oil, they extract oil, and then they get it into the refining process, which is midstream. And then downstream is the gasoline station that we go refuel our cars in. I believe Valero is mostly on the downstream operations. So they wait for the refiners to get the refining process done. They may own a few refineries, but refineries are really expensive. And in the US, the regulatory environment is very intense because they tend to pollute the air and pollute the water and pollute things, right? So I believe Valero is mostly downstream, markets and sells, and that's the key there. And so what I dislike about just being a downstream player is you're dependent on everything that happened ahead on that whole supply chain. So if they found the oil and they're selling it for $100 a barrel, you're going to have to pay that price. And then if the refining process adds, $10, $20 of value, you're going to have to pay for that. And if there's a disruption to the refinery, like that tends to happen, a refinery goes down and that lack of inventory causes prices to shoot up, then everything that happens above you in the supply chain, Valero has to deal with. So those are the aspects that I don't like pure play downstream oil companies for that reason, that it seems like their margins get squeezed. It's kind of like the tail on the dog. The dog, wherever it goes, the tail has to follow. It's a market cap of 46 billion. The revenue's 134 billion. And if we look at, just from a comparison perspective, let's look at Exxon. Exxon, Mobil. These guys are the biggest oil and gas company on the planet, 516 billion. 345 billion in revenue. And the point that I wanted to make is these guys are roughly less than a third or more than a third as large of Exxon. So you'd say, all right, just multiply 46 billion, so they should be worth a third of Exxon. Well, what's Exxon worth? 516 billion worth. A third of that's like 170 billion, but no, they're only worth 46 billion. So you see the valuation difference is the revenue from a downstream player is not the same as a fully integrated player. And if you look at Occidental is an upstream oil company. They primarily do exploration, find the oil. And if you're a very good explorer of oil and you can extract oil, that's the most profitable part of this business. But at the same time, if you're not good at exploring oil, you're going to lose a lot of money. Occidental is very good at it, and they have very good reserves. So that's why Warren Buffett owns Occidental, and Warren Buffett also owns Chevron. Mr. N. Kiter, you have a question, sir?
Yeah, just to add, the reason also that I brought up this Valero, because I noticed that they are treating the shareholders in a very generous way. I mean, I don't know if you can look at the shares buybacks, for example, in addition to almost 3% dividend. I mean, in the last 2 years, they were reducing their buyback, 10 years, 5 years average is 5%. But this is something that I was said, this gives a very nice floor to the stock. And they are making money. That's why I even bought a bit. I must admit or to add, like not a lot, like a very small position, but I liked what I saw. Maybe it's but thank you for the comments. I mean, the risk is clear. Yeah, it's not a safe bet for sure.
Yeah, and so Valero, to me, I put them like in the gray, right? You guys, this is my quadrant that I created, right? Now they have a lot of competition, right? You have other gasoline retailers and so forth. And from the sounds of it, is they're a very well operated company in the gray. They're really returning a lot of value to the shareholder. If you get a good discount, you can make money on companies in the gray. So totally on board with that. Just be aware of, what kind of company are they? It looks like, you bring up a good point, which is their buyback yield is 10%. So they're taking shares off the market. Very good. Very good. And, you couple that with a dividend of close to 3%, you have a shareholder yield of 13.48%. That's very, very good. So you bring up a very, very good point. That's attractive to me. I'm a big Chevron stockholder, so I can't buy any more in this space. I would violate diversification principles. But this is a very good stock. Yeah. So I think, Brian, you have a question?
Yeah. Have you ever looked at ProPetro? They're a oil service provider in the Permian Basin.
Yeah. Do you have a symbol?
PUMP.
Okay. Let me finish my thoughts on Valero, and then we're going to turn our attention to that guy. So, all right. So we have what has been established is a company that has a good partnership with stockholders. That's good. That's very good. If we look at the 5-year chart, it's been going up nicely, up and to the right. 87% return over 5 years. I think stockholders would be very happy with that. This is an energy company, and it seems like every recession is met with high oil prices, which is kind of unusual, but that's the case. They haven't been growing the last 2 years, and the main reason is oil prices were really high a couple years ago, and now they've been coming down. So they're, like I mentioned earlier, they're downstream, so everything that happens ahead of them is going to affect them. Oil prices are up, they're going to be able to charge more. Oil prices are down, they're not going to be able to charge as much. So that's the case there. Profitability, they've been profitable, good. Earnings per share, it's been solid. And what's interesting is they really had a lot of earnings per share in 22, 23, and then it's come down a bit in trailing 12 months. But those are really, really big numbers. Maybe that's why they're buying back so many shares, is that they made good money in 22 and 23. So that makes sense. Look at free cash flow. Yeah, they're a nice cash flow generating company. Very nice. We look at 8 billion, right? For this type of business, I would multiply this times, I would say 12, and I get to roughly $96 billion of value. And these guys are half of that. So you got a pretty good one here, Kiter. That's a pretty good looking stock. It's consistent. It's reliable. I've got a lot of nice things to say about this company and this stock. Again, the reason I wouldn't be a buyer is just because I own so much darn Chevron. But this looks pretty good. Looks pretty good. Turning our attention to ProPetro. And go ahead, Kiter.
Sorry, you know what? I have a more general question about the diversification, but I don't want to interrupt the others that also want to ask questions. So if you when you will have the time later, come back to me. I have another question.
Let's do it. Let's talk about ProPetro, and then we'll talk about diversification. All right. So we have ProPetro. So this is Integrated Oil Field Services Company. Okay. So they do services. They do fracking, fracturing, I think it's fracking, and then cementing and so forth. So they get an oil well ready for you to, once you've found oil and there's geology science behind it, and you say, okay, hey, this is where we're going to start extracting oil. Our friends over at ProPetro come into the picture. They are a small cap. They do about 1.5 billion revenue. Now these guys, their valuation probably follows oil prices. If oil begins to really go up in value, you're going to see see if you followed oil, you probably see that oil prices are increasing. Well, these guys are going to get really busy because oil companies are going to be like, hey, I've got reserves that are untapped right now. Let's tap them right away and call ProPetro, get them in the field and have them, start sucking that oil out of the ground. Now, it's not a bad time to look at this company because oil prices are down. I'm going to look at oil prices real quick. We look at oil prices over the last 5 years. And I follow oil prices because I own like $125,000 of Chevron. So I like to keep my eye on it. Now, it's been, from an oil perspective, it's been somewhat stable at around, 75. I think 75 is a pretty good number, maybe 77 or so. We haven't seen severe volatility like we saw in 22. Like in 22, we saw severe volatility. And isn't it interesting that in 22, it almost coincides with the stock market going down so much in 22. So if you see oil go up, stock prices come down. It's pretty interesting, huh? All right, so
wasn't 22 the year when Russia invaded Ukraine? I think that
could be.
it created a trigger, I think, for
Yeah, and I
somebody.
think the United Nations and NATO decided, hey, nobody can buy Russian oil because we don't want to support Russia during a point when they're invading another country, which they felt was unjust. So I think the removal of that supply caused the rise in oil. So yeah, good point. That's why I look at geopolitical tension and say, okay, is this going to cause a big spike in oil? So as we look at that little company we're seeing, you see this little drop here in oil prices. Maybe I can zoom in last 3 months. So we're seeing a drop in oil prices, a rise, and then a drop. So when we come back to Petro, you see rise, drop. They're following the oil market. In 22, when prices were really going up,
it's like the lowest producers cost-wise. I said they're in the Permian Basin, and they're like the lowest cost producers of oil right now. So they're pretty busy.
Well,
they're still making profit.
So I agree with you that they're in the Permian Basin, but ProPetro does not produce oil. They work for the oil companies who produce the oil. These guys get hired.
But the oil companies are making money they'd even make money at $60 a barrel in the Permian Basin.
I agree with you. I agree with that.
That's why these guys are busy.
I agree with you.
Their largest shareholder was Pioneer before they got bought out by Exxon. So they've got a 3-year contract with them.
These guys are part of Exxon now?
No, Pioneer owned 1/3 of ProPetro, and then when Exxon bought them out, Exxon now is their biggest shareholder, and they own. Let's say they have a contract for 3 years for 1/3 of ProPetro's rigs.
So I'm with you. Again, buying into ProPetro might be a good idea. Let's keep going, but the rationale behind that is you buy into the oil complex when oil prices are low, because when oil prices rise, your investment will go up in value. Now, right now, we're not necessarily super low priced, but it's probably a good time to buy into the oil complex, because if we have any kind of oil shock where oil prices go from 74 to 100, this stock's going to jump up 20-30%.
Yeah, and they're buying a lot of their shares back at this lower prices. I think they already bought back about 8% of their float this year already.
So they're buying back, 2.3%. And this might be a little dated. They don't pay a dividend, right? Which is fine.
No,
I don't really care. But they're buying back shares, which is good. All right, let's look at their financials. So their financials, this is somewhat of a cyclical business. But what's been impressive is, I understand in 2020, nobody was pumping oil because there was a big reduction of demand of oil. But in 21, they grew real nicely in 22. They grew nicely in 23. They haven't really lost many sales. This is impressive. This is good. Their overall growth is very good. So they are being hired. It looks like these guys know what they're doing, and oil companies are like, hey, these guys are a very good services company to help us tap and maybe recondition our oil wells. All right, so let's get into profit. So they have earnings, very good. They had very good earnings in 23. Didn't make a whole lot of money in 22. Lost a little money in 21.
Yeah, they bought a bunch of new rigs. They're going to an electric fleet. But they still got some of their diesel fleets, some of their other fleets.
So their free cash flow trailing 12 months is $148 million. It's a high point for the company. Now, when it comes to data, right, when I look at a company, I don't like to see this because you have negative, positive, lower, negative, low, almost zero, and then positive. It's like, man, I wish you would show me a nice upward trend, but they may not be in an industry that provides that. If you look at like Apple, they have a real smooth upward chart. It's like very impressive. But let's kind of keep going. So 148 in a year where, hey, trailing 12 months, oil prices are not through the roof. So that's very good. It goes to show that customers like their stuff or like their services. Now, 148, they're doing very good. So 148 divided by 843 is going to be roughly about 16% to 17% yield to free cash on revenue. It's very, very good. That's very good cash flow ending up from an operation that does, and I did the wrong thing. Sorry. I should have done, no, I did the right thing on market cap, because you're paying less than revenue for the company, about half of revenue for the company. So that looks pretty good from a valuation perspective. This thing would value at a severe discount. Like discounted by 100%. Because if you take 148 million times 10, you get to 1.48 billion dollars of value, but they're only being priced at 843 million. So does that make sense, Brian?
Yeah.
So this one's looking really good. You guys have two really good oil ideas. And this is a small cap. I've been talking about small caps. This looks really good. So let's look at debt just to make sure we're not getting into a world of problems. Total debt, 175 million. It has increased from pretty much zero, and it looks like they financed something.
They're new electric rigs.
Okay, makes sense. 175 million in debt. They have 74 million in cash. So net about 70 some odd. Net about $101 million of debt. Their EBITDA is $314 million. And what that means to me is if you have $100 million in net debt, you can pay off all your debt if you wanted to by operating your business for about 4 months. Very low risk. What you don't want to see is your EBITDA, it would take you like 10 years to pay off debt if you had to operate the business to pay off debt. You want it less than 3 years. You want debt to be less than 3 times EBITDA, in my opinion. So that looks good. Balance sheet's solid. Generally, they're growing, especially in a down oil price era. They continue to grow their revenues, which goes to show that oil companies probably really like their services. So I like ProPetro. I think I'm going to put that on my do more homework list and see if maybe I throw some money at it and maybe reduce my Chevron holdings. Chevron hasn't been performing all that great for me. Certain years it does great, certain years it doesn't. It is very sound company. So maybe I reduce that and buy into pump. All right, good one. All right, so let's talk about diversification. So diversification is, there's kind of a, so there, diversification, what you intend on doing is, if you put everything into like one stock, you're pretty exposed. You know, let's say you love Apple. So maybe you made a ton of money over the last 10 years because you love Apple. Boom, you're in it. But even Warren Buffett's, reduced his position by 50%. And they're probably looking at diversification as being one of the reasons. But the intent with diversification is you're trading in potentially higher returns for lower volatility. And when that stock stops performing, you have other stocks that are rising. That way you have, on average, a very good return with lower volatility. You don't want to be in a position because, speaking for myself, I'm investing for my family for the next, 30 years for my family to have everything they need financially. Okay. Now, what I wouldn't want is 2 really bad years where it's like, hey, sorry, family, but we're going to eat peanut butter and jelly sandwiches for the next couple of years. And we got to really tighten the belt like severely. Instead, if you're buying into the oil complex, it's great because if you buy right, you can make money, very good dividend industry, but you always invest in things you understand and also invest in, stocks that are in other industries. Like I understand healthcare, I understand oil and gas, I understand financials, consumer discretionary, that's easier, and technology. I've spent most of my professional career in technology. So I think I have a balance of diversification, but I never compromise. A couple of things when I diversify is, I'm not going to diversify into an industry that I don't understand. It's just too risky and I just don't understand it. I wouldn't be able to make a good decision. So it's only industries that I can totally understand and I can make a good decision. 2, I'm not going to compromise the prospects of a great return. Like technology return, great returns, glad I'm part of it. I had semiconductor companies in my portfolio, but I sold Broadcom, I sold Qualcomm, good returns, but I think they're just overpriced now. I'm not going to sacrifice great returns for over diversification. I don't want to diversify. I want to diversify. And I'm not going to buy safe stocks just to have safe stocks like consumer staples. I owned one, Kroger. It makes sense. It's been a good winner for me, but I'm not going to buy like, a couple of staple stocks because over 5 years, they don't do very well. I'd rather take my chances with really good technology, biotech companies, healthcare companies, buy really good stocks. Like I've been buying into Nike. That's really playing out well now. I think for a while it looked pretty bad, but I'm like, hey, I'll buy the #1 athletic shoe company any day. I'm buying into Amazon, buying into Starbucks. And I think those are, give me some diversification, but I don't trade in the prospects of high returns just to be diversified. If I can get diversified, that's great. And I don't buy really safe stocks. I think it's a bad idea for me. Like utilities, I don't touch them. REITs, I own one, but that's because I own real estate on the side as well. So that's my comments on diversification. And Kiter, you have a question?
Yeah. So, and diversification inside the sector. That's what I really want to ask. Like, for example, I like to find opportunities in the energy sector. Mm-hmm. But you said, like, for yourself as example, that you are holding only one and quite a big portion. I mean, I don't know what is percentage of the overall, but let's say any percentage actually doesn't matter. To hold in only once, I'm saying my opinion, in one stock in the energy sector, I feel that it will distract my sleep at night, because these companies from time to time can screw up. Like Exxon, you remember that it was years ago, but Exxon Valdez was the name, like the spillout that can ruin the holding, or suddenly a fire or accident or polluting the Gulf of Mexico, all kind of things. That's why I like, even if I like the energy sector, I have more than one. I have about 5 or even more. Like I have Exxon, I have Chevron, I have Occidental, and even a few others.
Yeah. So, I understand your point. Let's talk about it, and as I talk about it, let's look at something really quick. So you see energy here as a sector, and I'm going to drill into it further. Over the last 5 years, it's done 75%, but that's not like a top sector. The top sector is technology, no big surprise. Healthcare has done far better. Consumer discretionary has done better. Communication services has done better. So diversifying within energy, is it a very fertile place just to have consistent growth over the next 5 years? My answer would be no. It's a very good sector to buy at the right times and then watch your investment go up. But it's not a sector that, like, I own multiple discretionary companies, consumer discretionary. I own multiple technology companies. I own multiple healthcare companies. So I do follow your idea, which is diversify in sectors that, give you more exposure. You really like those companies. Like in healthcare, I own 4 different stocks. In technology, I own 6 different stocks. Consumer discretionary, 6 different stocks. Communication services, I own like 3 or 4 different stocks. And those are higher performing sectors. Okay, but let's go into energy real quick. So I get your point that, hey, what if Chevron screws up? And next thing you know, that stock goes down 50%. You're right. I am exposed to Chevron, and I could be hit with a pretty substantial loss. Totally agree with that. Can't argue that. So if you bought within the space of energy, like right now, I'm thinking maybe I add pump and take a little money off the table with Chevron. I totally think that's a good idea. Yeah, it's a good idea. Especially right now where oil prices are not high. You want to buy low, sell high, right? Didn't invent that. Everybody's kind of been after that situation for a long time. So I think that would be a good move. Good plan. Right, let's talk about Ford. So we talked about the oil and gasoline. Now let's put that gasoline in a vehicle. Let's see here. All right, so Ford Motor, this has been a stock that has completely surprised me. And here's why, is the current PE is 11.7. Ford PE is less than 6. They pay a very good dividend, but their market cap is tiny. It's like, geez, man, your revenue is $180 billion. So the company is worth less than a fourth of their revenue size. That means the market just does not like car companies. You look at their financials, it's a pretty good situation. You have revenue growth of the last 3 years and trailing 12 months of 6%. They're profitable and they generate high free cash flow. If you look at their cash flow, $5.2 billion. $5.2 billion. On a market cap of $44 billion, that means they're doing about 12% free cash flow yield. Okay. That's incredible. And they only do a dividend. They don't buy back shares. Maybe they should. Their balance sheet is decent. I think it's below 3 times EBITDA. So the automotive complex, right? It's just a really hard business. You have it's a complex manufacturing industry where you have to design the product, you have to procure the parts or make the parts, you have to assemble, manufacture, get cars distributed throughout the United States and the world. And I think that's what makes this business complex and less desirable. They generate a lot of free cash. Can't deny that. But I've been watching this industry, and if you look at, let's compare Ford, and I'm just going to look at the traditional companies, and we'll go with what's Volkswagen's symbol? So VW. I don't know what Volkswagen's symbol is. So let's go with GM. And then I think Toyota. Toyota's been doing well. So when we look at these companies, look at the yearly, General Motors is doing well. Toyota is doing okay. But man, General Motors is doing great. Their chart looks really good. So why is General Motors up and Ford has been down? Ford has been the laggard of these three big companies. It's really surprised me. I thought Ford was a really good company. I've always held Ford, above GM because it seems like they run just a better operation and better finances. But GM's been really doing well. And the long and the short of it is, when I look at the car business, I just don't like what I'm seeing long term. The biggest threat that I see globally to the domestic U.S. car companies are the EV companies coming out of China. These guys are making what I believe is a reasonably good product, and not necessarily competing here in the U.S. because I think the U.S. government is going to put very, very high tariffs on EVs coming out of China. But when you look at Mexico's economy continues to improve. Their middle class keeps growing, and they're buying EVs at 10 grand a pop, where here we pay, 30 grand for an EV. You can really get up there at car prices here in the US. Very easy to get up to $100,000 to buy a car. So this is the biggest worry I have for this space is China has taken industries, for example, PCs. When I first bought my first PC, it was assembled here in Orange County, and the parts were procured. A lot of the parts did come from Asia, boards and semiconductors that are very toxic. They get manufactured outside the US because here in the US, there's a lot of regulation. And it was assembled here in Orange County, California. And then probably my second PC was probably manufactured in Texas because I think Compaq, HP had big operations out there. And very quickly, 15 years ago, PCs started getting manufactured in China. And that's where they've been ever since. I think most electronics are assembled, the iPhone, assembled in China. They do certain things very, very well, and they become kind of like the center of that particular industry's manufacturing operation. So that's what happened with phones. That's what happened with PCs and other products. And I believe that's what may happen with automotive. If you start stamping out cars that are really affordable, yeah, you can buy a Tesla or a GM EV or a Ford EV and feel like, hey, I'm getting a better quality product. And you may be right, but you're paying a 75% premium on what you could get from a Chinese equivalent. And the Chinese, they put out good products, man. They put out pretty good iPhones. I've got an iPhone right here. It's got a couple years and a couple miles on it. It's been a pretty good damn device. And you see other products, they put out pretty good product. I don't think cars are going to be an overly difficult product for them to master. That's my biggest worry with Ford is they may be competitive here in the US, but you get outside the US, and I believe in Europe, I saw, right here. So China meets automakers to discuss import tariffs on the EU, right? Within Europe. I think Europe has got a couple important companies that they got to protect, Volkswagen, BMW, and other companies, mostly out of Germany. But so does France has an auto company. Italy has an auto company. The UK has auto companies. But I think if you put tariffs on products, the consumer loses because you're keeping a very low-cost product from entering a market. You're trying to preserve jobs. I get that. But boy, when you go to Walmart, 80% of those products are manufactured in China. You go on, Amazon, 80-90% of those products are manufactured in China, and they become the manufacturing source of the world. And why would cars be outside that efficiency model? That's what would be my biggest worry with Ford, GM, and Tesla is how are they going to deal with China? It's going to be very hard to compete, especially in Latin America. Latin America has no, jobs to lose if they have the Chinese come into their markets. They actually have jobs to gain because the Chinese are opening manufacturing plants in Mexico, Brazil, Colombia, and they'll be manufacturing a lot of cars onshore to those countries for them to sell in those countries. So it's going to make Ford, GM, Tesla less competitive over time. That's my biggest worry of the space. So I'm staying out of automotive. I was a Ford stockholder for a long time, have recently sold my shares. This drop just was, I could not explain why Ford was dropping. It's like, why does the market hate Ford? Maybe I was in the wrong one because GM's done far better. But you can see that with the last pullback, car companies really took it. And some of them have risen faster than others. Looks like GM is winning the appreciation battle. Maybe GM's the car company to consider. But for now, I don't want to buy automotive. And the reason for it is, I used the Valero example, but automotive at best is in the gray. And it just becomes too hard of an investment or too hard of a company to operate. Over time, it's just going to get harder. I just talked about China being a competitor, but if EVs are going to be simpler and manufactured around the world, it's going to really make their addressable market smaller. And if the addressable market is smaller, at some point, some of these companies are going to start going to the red in automotive. And I'd rather not be in industries like that. I'd rather be in industries that are here. This is the goal. So let me just keep the capital available. Right now, it's hard to invest, but maybe small caps that meet the criteria and potentially will be very good companies in the green. That's what I'm going to go after. Healthcare companies in the green. That's what I'm going after. A company that owns or developed a patent on a drug that really helps a lot of people with a disease or a condition. That's the company I want to buy into instead of a automotive company that's facing a lot of challenges. All right. So it looks like you wanted to look at Ferrari. Somebody wanted to look at Ferrari. Let me check my comments here. Yeah, Ferrari is a different animal altogether. Ferrari doesn't make that many cars, right? Yet their stock price is like, what a beautiful chart. But what they do is they sell cars, but they also license their brand. So when we talk about Ferrari, it's almost like Chanel or Gucci or those premium brands. It's not that Gucci is selling a ton of purses for $5,000 a piece. It's that they get to brand that logo and they put it on a variety of products, and that's they start making a lot of money because when you charge a royalty, it's very profitable. Let's take a look at their financials, and really we got to look at their actual financials to see the royalty income, because stock analysis won't give me that type of detail. So let's go to Ferrari. Now, I haven't seen the new Ferrari movie. I don't know if you guys have seen it. I'm going to wait for it to come on Netflix and watch it. But that should be a doozy, the whole story behind Ferrari. All right, so results and presentation. Okay, let's go here. Okay, first half, report. Yeah, let's go to the report. So here's the first 3 months, first 6 months. I believe this is in euros, okay? We have revenues, cost of revenues. And they don't break out their types of revenues. Maybe they do on another schedule. Let's see. Cash flow, they cash flowed about 604 million. This is in millions of euro. Okay. Hoping they break out revenue and show us where the revenue is coming from. So here it is. So cars and spare parts, 2.8 billion. Sponsorship, commercial, and brand, 312. Other, 128. So it's not as high as I thought it was going to be, but that's where it's at. I wonder if they show us cost of sales. So here's cost of sales. And I don't know if they're going to give me what I need, which is I'm trying to show profitability to that category of like sponsorship and brand, because I think this is where they make, I think this is like 80, 90% margin. This is probably a pretty good margin because there's demand on their cars. Coming back to their free cash flow, right? They have 1.3 billion. Is this in dollars or euro? Then it's in euro. So 1.3. Okay, because that was 6 months. Okay, that makes sense. This is trailing 12 months, and the report I saw was only for 6 months. So if we multiply that times 20, we should get to about, let's call it 25 to 30 billion dollars of value, and they're at 86. I don't know how we're getting to 86 billion dollars of value here. Their revenue is growing, but not like incredible, right? It's growing at 15%. Probably the stature of the brand, right? I don't want to buy a Ferrari. It's too much money to spend for a stinking car. And then when I park it, when I go get a cheeseburger, In-N-Out burger, I'm afraid somebody's going to door ding it. So it's a very wealthy category product. And the revenue, you're paying about 14 times revenue for the company. It's just this premium brand. Hey, people want to own Ferrari. PE is 58, very high. 51, very high. So it's not an investment I'd make, but if somebody wants to own a share of Ferrari to say, hey, I own Ferrari, there you have it. So interesting stock. All right, so we went over a couple of stocks there. All right, so let's talk about real estate. We talked about a few stocks, and I'm going to kind of go through a flow of investing with real estate that I've got prepared. Now, I imagine everybody on this call either owns their principal residence or owns a property of some sort or has thought about owning real estate. And I wanted to kind of go through my rationale and my thought process of real estate. And you have real estate tends to move real slow, meaning the appreciation rate of real estate tends to be real slow, like 3-4% a year. That's normal. This is like normal here. And we had a period of time in the late, 2006, 2007 era when it started to appreciate way too fast. And we had a lot of bad mortgages, which caused a very good correction. Here where I live, prices came down by like 40%. Never saw that in my lifetime. Now, as we go forward, you can see that the appreciation rate was much higher going forward. And that was caused by really low interest rates and just people wanted to be in real estate. I'm okay with it appreciating quickly, especially coming off of a very good correction. But when we got after COVID, this is where it's appreciated super fast. And I think we have an overpriced market. Okay. You look at the pitch on this chart, that trajectory, it's really gone up. So having said that, I think investing in real estate is really treacherous right now. We got to let it calm down. We got to see a year or 2 or 3 of depreciation or prices coming down before I think it would be a good market, because it's just seen such appreciation. As I look at properties in Southern California, here's a property that does look pretty good to me. And this is Southern California, so it's a little expensive. This property is priced at $975 million. This would be for a 2-unit property. You would rent. In my case, I would rent both units. This is a back unit, it's a front unit. It's got a garage in the back. And the cost, if you look at the mortgage, insurance, a couple other costs, the negative cash flow would be $6,133. I think I could probably rent this place for about $5,200. So it'd be cash negative by about $900. Here's another property. This is, I believe, a 3-plex or a 4-plex. This is a 3-plex, a triplex. Okay. And pretty expensive, a little over $1 million. So in order to buy a property like this, you got to put up 25%. And you're looking at a little over $300,000 to get into a transaction of this type. And what I wanted to point to was this, that I'm beginning to see price decreases quite consistently as I look at properties that have been around. So this has a price decrease on August 11th. It went from $1.2 million, which is where they listed it at, and it's been brought down. So prices are beginning to come down on real estate. And this is a little bit of anecdotal data, but I do look at the market from time to time to see, how the market is behaving. So price decrease on this particular property. The investor that bought this in 16 is doing quite well. They bought it 710, and they're probably sitting on a nice gain. So good for them. Looking at this property, this is a 4-plex property. They want 1.7 million. You can rent 4 units. The cost monthly cash flow, negative cash, would be 10,756. I think I could probably rent this place at full occupancy for about 10 grand. So you'd be cash negative by $756 per month. And this one here, if you look at the price history, it was listed. And this one here, what I wanted to point out is the investor bought it in 2021, bought it for $1.65 million. And they're trying to get out of it at 1.7 million. It's been listed for 54 days, so it's not selling. And at this rate, it's going to cost you 5 to 10% in selling costs. You got to pay the agent that's selling it. You got transaction fees. You got a bunch of transaction fees they're going to apply. Since it's becoming a buyer's market, you may have to buy down the loan for a buyer. And overall, you may have to look at a discount. An investor may come in and say, I'll give you 1.6 million. Long and the short of it is, this investor is either going to break even at best or lose some money. And that's a 2-year, 3-year time horizon that they've invested. And at 1.6 million, they had to put roughly about $400,000 of capital to buy this place. That's a lot of capital to be sitting there, and you barely are going to break even. You're probably going to lose some money. And that's why real estate, you have to invest at the right times. If you invest at the wrong times and you bought here and the market goes down 40% and you bought it at 1.6, you just lost all that money. That's a lot of money to lose. So that's an example of what you don't want in real estate. Here's another. Did we see this example already? This is another price decrease, decreasing from 1.2. We saw that example. I believe this one had a price decrease. So I'm seeing a lot of price decreases in real estate. There's a price decrease. This investor, he's been in it for 3 years. He's trying to get out of it and make some money. I don't know that he's going to get that price. That property does not look very desirable. It's not in a very desirable spot. This one is probably going to, this is a home flipper. They, improved this property, try to make it look nice. They're asking a high price. They've already had, I think, a price reduction. Had price reduction, $30,000. They bought it for $700,000 a year ago, a little over a year ago. They put capital into it by fixing it up, maybe $50,000, maybe $70,000. Now they're trying to make a profit, which I think might be a challenge for them. Once you look at the selling cost, maybe they net $900,000, maybe $850,000. And if you compare it to their capital and all the effort they put into the property, this may have been kind of a very modest return on investment. So real estate is a doozy to really try to get right. What I've done is I've created a spreadsheet. I shared this with Scott online, and if anybody else wants it, send me an email and I'll send it back to you. The 2 unit that I thought was the best property that I showed you, if you bought that property today based on a model that I put together, you put down your capital, you put $244,000 of capital in, you'd have expenses when you buy, you'd have property taxes you'd pay, you'd have maintenance on the property and insurance. And the first year, you're looking at a very negative cash year. Obviously, you had to buy the property. Now, in the first 5 years, if you held that property based on what I'm expecting that the first couple of years, we're going to have price decreases. And I'm not going that crazy. It's like decrease it by 5% each year. And then rents are going to increase by 6%, which have been increasing in California. And then long-term growth of 3%. If you own this property for 5 years, you would lose 6% per year. That would be the internal rate of return. If you kept it for 10 years, you'd probably have an internal rate of return of 10%, but the stock market's probably going to do better than that. And this internal rate of return is not much better than a bond. You can buy a bond that has about the same amount of risk that's going to yield 6-7%. And you don't have to manage a property. You don't have to deal with the headaches. You don't have a bunch of effort to put into it. It's a nice, safe bond that gives you not quite 10%, but far less risk. If you keep it for 20 years, yay, 11%. These are not very good returns for the level of capital that somebody has to put in and the risk you have to take. Getting in and out of real estate is very difficult. The fastest way you can sell a property, it's going to take you 3 months. If it's a slow market, it could take you a year to sell a property. And if it takes you a year, you're probably reducing the price. So real estate's quite risky right now. We're not quite there. We need a couple years of, the price is coming down by 5%, 10%, and bringing down those prices. Hopefully interest rates also cause mortgage rates to go down. That makes it more favorable. And real estate's a lot like the stock market. Once you have the market realize that, hey, the market is bad, it's going to be a declining market, then you're going to see less sales because buyers are not dumb. They're like, well, I don't want to buy a property that's going to lose value. I have a friend that bought a property 3 years ago. Now they can't get rid of it. They're moving because they have to move jobs, and they bought the house for $800,000, and now they have to sell it for $700,000. They're losing more than $100,000. I don't want that to happen to me. So that really begins to put a lot of fear in the market, and prices will go down. Now I've been wrong before. I may be wrong again, but I've been right before, and I might be right again. And we'll see. We'll see how things play out in real estate. But for now, I'm being very careful. I'm going to do my homework on properties. I'm going to drive the most attractive terms for myself and my wife as we make these decisions. It is nice to have properties that produce income. It is nice to have properties that you buy and then you wake up 10 years later and they're worth, hundreds of thousands of dollars more. So you've made equity. I like to use the term, you make money while you sleep. Real estate helps you make money while you sleep. So That's a flyby on real estate. Any comments that you guys want to get into, or any questions, any feedback on real estate, what you guys are seeing? All right, just go for it.
You showed the examples from the real estate in your area, probably in California, which is relatively expensive. There are places in the US, like in Ohio or Philadelphia in some places, and other places where properties are sold from, I would say, I know personally some of the areas. I don't want to get into details, if you may, but the relatively decent properties, let's say after the price increase, they are, let's say for 180 grants and up, you can buy. The only issue that it's not under your hands. You need to give it to someone else to manage, and that's actually chew up quite a portion of the income.
Yeah. And Kiter, you make a very good point that, for example, I live in California, and Phoenix, Arizona is, if I got in a car, it'd be about a 6-hour drive. And if I got in an airplane, it'd be less than an hour flight. But real estate in Phoenix is far less expensive than it is in California. But you bring up a good point, which is, okay, but then I'd have to hire a property manager. And if I ever needed to go to the property, obviously I'd have to drive there for 6 hours and back. That's 12 hours, and it's not fun to drive. If I flew there, then I'd have to get myself to the airport, fly there, the expense of that. So that has to be taken into account. I think you can find markets in the United States where you can buy a house for $100,000. Those exist. But I would say that, with real estate, there's some dynamics that cause real estate to go up in value. One of the principal ones is job growth, population growth, job growth. If jobs are growing in a region, people move there, especially young people that are forming households, that are getting married and saying, hey, to their spouse, let's buy a house. And then they buy a house, and they start a family, or they don't start a family, but they live together. And all those things happen where there's job growth. Phoenix is a job growth area. Maybe Ohio, you were saying, is a job growth area. But you do have to keep in mind that if you hire a property manager, you're going to have, it's almost like buying an ETF. They're going to be managing a lot of the decisions, and they're going to charge you for it. Typically, it's like 10% of the rental income. And you pay for everything, by the way. If there's a plumbing issue, you're going to pay for that plumbing issue. If there's a, whatever issue with the property, you're paying for it. One of the things that I do, and it kind of mirrors how I manage stocks, is I don't buy any stocks I don't understand. I want to do the research. I want to understand them. So the real estate that I've bought is something that I can go, visit. And I had properties that were a couple of hours away. I had a very good property manager, had a very good relationship with him. And that proved to be a pretty good situation for me. So it's not like, one way is better than the other. I have thought about buying real estate out of state, where the acquisition cost is easier. I may do that, but I'm still going to wait for prices to come down. I think prices are too overheated. You saw the chart that I put after COVID. It just got really, really nuts. And I'm really glad I had real estate as an investment. And it's my biggest value in my portfolio. I'm probably, if you looked at my portfolio or my net worth, I'm probably 65% real estate, 25% stocks. Bonds would be like 5-7%, and then everything else would be cash and crypto. So the reason it got to 65% on real estate is it just went up so damn high. And I sold 2 properties a couple years ago, created a lot of cash, which ended up in stocks and bonds. But that's after the sale of 2 properties. So, Scott, you have a question?
Hey, yeah, Victor. Just a real quick note is you were talking about kind of a comparison to ETFs when you have a property manager. Now, not tax advice, right? Just maybe general advice, also because I've been doing my own taxes for a long time, and I've been renting out a property for several years. But wouldn't it be different to ETF fees? Because unlike an ETF, where you have management fees, which you can't deduct from taxes, if you're renting out a property, generally speaking, aren't you able to deduct that? Consider that like a business expense?
You could. Yeah, you bring up a good point. I thought from a analogy perspective, I was using an ETF analogy, but it probably wasn't a good one, which is, you bring up a good point that if you hire a property manager, that's all deductible against the revenue you're producing out of that asset. And it's fully deductible in the US, in California. I've been doing my own taxes, and I was educated in accounting, and I was educated in tax. So all those fees are deductible against your real estate. And if you treat your real estate right, it's deductible against your ordinary income as well. So that should be fully deductible. You're right.
Yeah, but I get it. It's DIY versus paying someone else to
Yeah.
do it and giving up some control. I get that.
Correct. Like an ETF, you can't call the ETF manager and say, hey, I want you to buy Apple stock. They probably be like, no, it's not how it works. You buy our ETF and then we make the decisions. That's kind of like a property manager. And oftentimes you can't tell the property manager, hey, don't hire that plumber. It's kind of expensive. I'm shopping around and I see plumbers half the price. They'd be like, that's not how we work. That's the plumber we trust. That's who we hire. Yeah. So yeah, it's a real estate investing is different than stock investing. Real estate investment is hard to get in. It's hard to get out. It's a long-term investment. It should be deemed as a long-term investment in all occasions, because I just don't see how you could, buy and sell at a profit with the transaction cost that exists with real estate. Stocks, you could buy a stock at 10 a.m. in the morning and sell it at 10:15 in the morning. It's that easy. No problem. Nobody asks one question. It's very easy to get in, very easy to get out of a stock. So very different. All right, everyone. So we've had a very good session. Thanks so much for tuning in. I appreciate it. And it's great to have a couple regulars. I'm going to keep this going until, hopefully it keeps growing, but I'm okay with it being just a couple of, key participants. I wouldn't know what to do if there was 25 people on and I had 100 questions. But overall, not on this call, but if you can write on reviews and stuff, any feedback, suggestions on how to bring something to the community that you think would be interesting, or something you're seeing that you think is not that good. I'm really open to feedback, just so that I do more things that people deem to be valuable and interesting, and I do less things people feel like, that's not that interesting. I won't take it the wrong way. I have respect for all of you guys, and I really appreciate you guys attend this call, as well as you participate in the community quite often. With that, everybody, enjoy your Sunday. Hopefully you had a very nice day. Fingers crossed that this week's going to be in the green. Let's see how things play out. I'll be doing a live stream each morning. I'm going to do it on stocks, but I'll provide all the details on the community page. You can attend each morning. I'm going to open the stock market each day from what will be 9 a.m. Eastern until 10 a.m. Eastern each day. And I think that'll be fun to do. And I'll probably do a couple videos this week, but we'll see how many I can get to. For sure, I'm going to do NVIDIA and a few others. So everybody, thanks for tuning in. Have a really nice afternoon.
You too. Thanks, Victor.